Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with the man, myth, the legend, Mr. Dan Bird. How you doing, sir?
Doing well. How are you?
I'm doing well. So we had our emergency session last week. Thank you for doing that. Kind of highlighting that the market makers were set up to have some potentially big losses. Thought that
Well,
there might.
let me clarify something
Sure.
to make sure that everybody understands this. The market makers do not have losses.
Ah, okay.
They don't lose money, no matter what happens. It's
Okay.
just how can they lose less money, or
Ah,
how can they make more money
yeah.
or otherwise? But they're not going to lose.
They're not going to lose. Yeah.
They're going to take the opposite side of the trade every time. So they're not going to lose money no matter what. You don't have to feel sorry for the market
No,
maker.
don't feel bad. No, but they did seem to be rather one-sided, at least given our emergency
Right.
call last week.
Right. Tom Bowley calls options expiration week opposite George week.
Opposite George week. That's cute.
Okay. If you know Seinfeld at all.
Yeah, I do. So, okay. So, and then it was kind of a weird week until Friday. And then Friday, it just, everything rolled over.
Right. So it started Thursday a little bit. But
yeah. So when you look back at last week, what'd you see?
All right. Well, let me first share my newsletter, and
yes, please.
There's something in there that we'll talk about on this topic. Okay, here's my newsletter for this week. You haven't read it yet, but
I have not.
It's okay. This is so these are the cartoons. If anybody is interested, just send me an email, breakpointtrading@gmail.com, and I'll add you to it. And if you want to stop getting it for whatever reason, just send me a note. I actually did get one this week. Someone said, please take me off. And
there we go.
Removed them right away and said, done. Thank you very much. So that's fine. No big deal. I do it for my own research, basically, and then just share it with folks if you want to see it. But so and I've got cartoons in there too. I'm not sure what happened this week, though. I don't know if my newsletter was too big or what, because I got a few permanent failure errors on a few emails that came back. And one was a friend of mine. So I shot him just a blank email, see if he got it. And he said he did. So it's something, it's either the thing is getting too big, which might be the case. I might have to cut things down. And it's just not going through some email servers for some reason.
Yeah, maybe.
I'm not really sure why. It was about probably 7 or 8 folks out of about 600.
Oh, okay.
But I'll see if I can fix that. But anyway, I'm going to talk about this chart here in just a second. But this is the email or the newsletter if anybody wants to receive it. breakpointtrading@gmail.com. So back to your question. This one here is from Stock Traders Almanac. And what they do is they do an exhaustive amount of research going back 100 years on the stock market. And they identify trends in the market, historical trends, and what the market has typically done. That doesn't mean the market's going to do it every time, but at least gives you trends. Now, this one goes back 21 years, and it shows each of the indexes, Dow Jones, S&P, NASDAQ, Russell, and what they have done during the month of August. So this is kind of the basis of last week's newsletter. When I talked about the market makers and options expiration coming up, and the market has just been going up, for the since June, basically. Yeah. So there's lots of call options that were coming due on the 19th, which is to the market makers' advantage if those somehow expire worthless. Right. And for that to happen, the market has to go down. So the trend or the probability was that the market was going to go down by Friday. Now that usually carries into the next week as well, because market makers are still reconciling their books. So they could continue to sell in the next week. And I expect Monday to probably be a bad day. Monday, the 19th of the month is usually the worst day of every month. Not just August, but every month. And then the Monday after options expiration usually is a challenging day as well. So I'm expecting the market to go down again Monday. And as you can see, I put brackets, I put lines on next week as well. So this is next week's period. So you can see Monday, this is showing historically it goes up a little bit, but then by next Friday, it comes back down. Okay. So we'll see. We'll see what happens. But this is what I put in last week. And this is one of the reasons. I had about 3 or 4 reasons why I thought the market was going to go down.
Okay. Yeah.
And then this is September. So this is also from Stock Traders Almanac.
Oh, interesting.
This is what they see for September. Historically, what September is typically done. So you can see the first week is Labor Day, and really the first half of the month is just going sideways.
Right.
Until options expiration, then it goes up. Now, if the market continues to sell off between now and next options expiration, then there's going to be a lot of puts in the market. And for the market makers to make more money, they're not going to lose money, but for them not to lose it, or for them to make more, their probability is that they are going to have the market go up, so that all those puts will expire worthless.
Got it.
That's what Tom meant by opposite George week. If the market's going up, then the market makers want it to go down.
Right.
And if the market's going down, market makers want it to go up. Something interesting about last week is one of the best performing industries was renewable energy. And so that's where a lot of calls were. And Friday, renewable energy took a big hit.
Yeah.
So again, opposite George week.
There you go. I gotcha. Okay.
And then through the rest of September, you can see what it does. It just goes down. So I think we're going to have a very challenging next 6 weeks coming up. There's a lot of things in the middle of all that. I put it in the newsletter. Things like the next inflation report is on the 13th. The jobs number is on the 2nd. And then the Fed meeting is on the 21st.
Yep.
So all of those things could affect what happens.
Yeah, it's going to be a very interesting September. Okay.
Yeah. So that's kind of the historical view of what has happened. Let me show you a couple of charts. Just to see where we are right now. So this is my Keltner channel chart. So these channels right here are based on the ATR, the average true range. So the average range that the security, in this case the S&P, travels within one period. In this case, it's a daily chart. So one average true range is the amount that it typically the security travels within one day, from top to bottom, from high to low. So it's the average for one day. Over here, you might can barely see it, but the ATR is $60 that the S&P has been traveling in one day.
Okay.
Now that's the dark green shaded area in the middle. The next one, the next band out, is 2 times the average true range.
Okay.
So 2 times its average daily range. And then the lightest one on the outside is 3 times the average range. Gotcha. You can see it rarely gets as far as 3x. Doesn't get out there very often. And when it does, it doesn't stay there for too long, because markets and stocks like to revert to the mean. Come back to the center. The center line is the 21-day moving average right here, which is this dotted blue line.
Yep.
So that's what it's doing now. You see it actually made it into 4x up here. That's very rare. You can look back here, and I mean, maybe back here in February, it almost made it to 4x, the downside.
Sure.
But very rarely gets that far. So it was due for a pullback.
Right.
So we're probably going back to the mean, which is 4150, and probably will overshoot it as well. So it might make it down to the bottom side of the ATR, or maybe even 2x ATR, so somewhere around 4100 or so.
Okay.
That's where I think it's headed.
Okay.
Now, by the way, what's going to happen is the news media has already, grabbed a hold of this. And they're talking about, oh, the market, we had our bear market correction, bear market rally. It's over now. We're going back to the bear market. We're heading back down. Right. So that's what you'll hear in the media. That's what you hear on CNBC. And one thing I put in my newsletter is on two people on CNBC, as the market was starting to roll over Thursday and started crashing on Friday. Friday, they're like, I don't understand this. I don't know what happened. I just don't understand what happened, why the market should be going down like this. Like they don't understand how market makers work.
Yeah.
Believe me, they do. I mean, market makers, it's legal theft, basically.
Wow.
You know, you'll get Goldman Sachs and you'll get all the analysts on there saying, oh, the stock is going to the moon so that people will buy it. And the market makers then are selling it so that they can make money.
Yeah.
That's how it works. That's how the stock market works.
Yeah.
So you have to understand that. So I just thought it was funny that they just seemed so baffled about why the market was going down.
Yeah.
I mean, it's pretty clear to me. This is my rotational chart.
Yep.
So one thing that I'm watching to see, you know, if this really is going to be going back to the lows again. You can see here it hit 4,300, which is a very critical support level, all the way back here into, you know, September, October timeframe. 4,300, we hit that and we bounced and basically got rejected.
Rejected. Yep.
At 4,300. There's another support level that we made it through, which would have formed the neckline of the inverted head and shoulders. You can kind of see it there. Left shoulder, head. And then we hit the neckline and we went right through it. Now we still could end up making a head and shoulders. We'll see what happens.
Okay.
Now we're heading down, so we have to watch this 4,150, which just coincidentally happens to be the reversion to the mean.
Right.
Back on this one.
Yep.
It's 4,150. So we'll see what it does when it gets there. It's also the 21-day moving average. I think it's going to probably go beyond that. It might even hit this on Monday. But I think it's going to probably go down to 40.50, somewhere down here before it turns back up. Now, if that happens, we might actually end up making a right shoulder.
Okay.
And then the inverse head and shoulders pattern is back in play again. Then we'll just have to watch to see if it comes back up and breaks through the neckline up here.
Okay.
But the thing that I'm watching are these rotational components of this chart.
Yeah.
So I've been through this before, so I'm not going to spend too much time on it. But back in December, when the market was making new highs, all of the aggressive sectors were making new lows.
Right.
The NASDAQ versus S&P, consumer discretionary versus staples, growth versus value, they were making new lows. This was the warning sign that the institutions were rotating out of growth, even as the market was making highs, and back into staples and value areas. And that continued all the way through till June. And then in June, as the market was hitting new lows up here, these rotational components started making new highs, meaning the institutions were rotating back into growth areas. And they continued doing that. So that this was kind of our first canary in the coal mine, that things were reversing. But now it's really obvious, because the market's gone up so much, really obvious that institutions are rotating back to growth. So I'm watching this trend line, number one, and you can see we're right back to the trend line right now on all of these. And we could very well break through it. In fact, I expect that we will probably break through it.
Okay.
But the next thing to watch is this low. So the low back here in June, will it come down and break through this dotted line down here, this low?
Okay.
If it does that, then the rally is over. We're going back to new lows. We're probably will take this bottom out, and we maybe head to 3,500.
Got it.
But if it doesn't do that, if it does come down to here and starts back up again, and these things do not go break this trend line at the bottom, then this is still intact, and institutions are still moving into growth. And then that just confirms that we're headed back to the highs. All right, so this is a chart of going all the way back to 2009. This is the secular bull market that I've talked about so much. Secular bull markets last about 20 years. So we have about 8 more years left to this one. And you can see that even in a secular bull market, there are times when there are cyclical bear markets. These circles right here show them. Here's 2018, here's 2016, 2011, 2010. But in each one of these, they came back to the center line and started back up again, except for the COVID. Except for the COVID one. It came down and went right back up. So that's what we did this time.
Okay.
Came right back to the center line right there, and now we're headed back up. So this is just nothing more then another cyclical bear market, in a long-term secular bull market, just like we've had before. And we're probably headed back to the highs or even higher.
Okay.
Incidentally, the view of a secular bull market is this right here. And I put Tom Bowley's session that he's doing this Saturday, the 27th. I put it in again in my newsletter.
Awesome.
I guarantee that he's going to talk about this. This is his chart.
Right.
But I will guarantee he starts everything off with this. And this is the thesis for what he's doing. Everything that he does, he says we're in a secular bull. So there will be times when we have recessions, and there will be times when we have corrections. But within the secular bull, the market will continue higher.
Got it.
And in these two, this is the last one here, between 1981, 1982, until the dot-com crash in 2001.
Got it.
All right, 20 years worth. And this is the one we're in now. So we've got about 8 more years left. In both of these, can you pick out the COVID crash, and in the first, and the one we're in now, and the 1987 crash in the previous one?
Well, I can see the COVID crash.
COVID crash right there.
Yep. And then 87.
Right there.
Oh, yeah, there it is. Yeah, that one.
There's 87.
That was 7.
Right.
Yep.
Now, both of these, in the context of a long-term secular bull, are just blips.
Blips, yeah.
Just blips on the path to higher highs.
Got it.
And the PPO up here, you can see he's highlighted these in purple. You can see this line stays above the 0 line throughout the bull markets. It's only in the secular bear markets that it goes below the 0 line.
Oh, I gotcha.
We're still above the 0 line up here. So that's the thesis of everything that I'm doing and everything that he does as well, is that we are in a secular bull market. So this is the interesting something that happened last week. This is a short-term 3-month chart. It shows the 3 CPI components now. Let me move this one up a little bit. So the 3 CPI reports, there'll be another one in September. So 8.6, 9.1, 8.5. You can see the VIX continued to go down.
Yeah,
The 10-year treasury continued to go down. You know, if bond traders are concerned about inflation, why would they be buying bonds, pushing the euro lower? But look what happened last week.
Yeah, I was going to say bonds started to act different last week.
Yeah, so we're back at 3 right there on the 10-year, and the VIX has started back up again. So that's another reason why I think the next 6 weeks really is going to be challenging in the market.
Yeah, I think, yeah, we're going to see if the 10-year can break 3 next week. And, you know, should we be back to the 3.49, which I think was the cycle high?
Yeah, we could. We could be back there, and depends on what the inflation report shows on the 13th. Even the jobs number on the 2nd.
Yeah, the job. Well, yeah, I think the jobs number
going to have a play here. Now, this is another thing that I showed in my last week's newsletter. One of the reasons why I said the market was probably going to go down this week, and this just confirms it. But it's a really good education on what to look for in charts. So this is a 65-minute chart. So there are 6 65-minute periods in a day. So 6 of these bars equal 1 day.
Got it.
Basically. Actually, no, this is a 10-minute chart. Sorry. This is a 10-minute chart so that you can see the days down here.
Okay.
But here's the S&P trending up for 1, 2, 3, 4, 5 days. But at the same time, the momentum indicators, the PPO and the RSI, are trending down. That's negative divergence. That's one of the things, that most important things that I look for in charts, are the momentum indicators trending the opposite way that the stock or the market is.
Interesting. Okay.
And if they are, that means it's running out of momentum. That means, you know, the direction is starting to get weaker and weaker. The momentum's getting weaker. It's running out of gas, basically, and it's about ready to turn over. So this is one of the reasons why I said that this past week would probably be lower. And you can see what happened on Friday. It was actually trending down the whole week. but Friday it really dropped off the cliff.
Yeah.
That's when options expiration came in.
Got it. Okay.
Right. And then same thing on the NASDAQ. You can see there on the NASDAQ, NASDAQ was trending up while momentum was trending down. So running out of gas, running out of steam, getting ready to roll over, which it did. I think it's going to continue into next week at least.
Okay.
And then the US dollar, which I said to watch for, if it breaks through this 21-day moving average down here, which is now at 104, then it'll probably be good for the stock market.
Right.
But look what happened Friday.
Yeah.
Started to go back up again.
Okay.
So I think all of the indications say that we are set up for more losses next week, more declines. Be careful. Look at your watch lists. Identify good stocks, which is what we're going to do in the next session today. But I wouldn't be putting a lot of money to work right now. If you're in cash or have a lot of cash, I'd sit on it for now.
Yeah.
And see how the end of August and September play out.
Gotcha.
September is the worst month of the year, by the way.
That's what I wasn't sure if it was September or October, but yeah.
Yeah. September is the worst month of any year.
Okay.
October gets a bad rap because that was the 1987 crash and it was a 1929 crash. Just those two crashes give October a bad rap.
Gotcha.
So October has a tendency sometimes to have black swan events, but they're rare, few and far between. Okay. September actually is the worst month of the year.
There's reason to sit tight just for that. Get your shopping list ready.
Yep.
Very cool.
So let me show my newsletter one last time here.
Yes, please. There you go, folks. Breakpointtrading@gmail.com. If you happen to be listening on the podcast, breakpointtrading@gmail.com. And episode number 2, we're going to use charts to go fishing for a deal or a stock of the week. So Dan, thank you very much.
We're going to use stock charts. And if any of the listeners out there are using stock charts, I'll show you some of the ways that I use it and maybe give some pointers that might help people if they're using it as well, or somebody that might be thinking about using it. So it'll not only be kind of an education on how to do searches and find a stock, but also how to use stock charts to its fullest.
I look forward to the session. Thanks, buddy.
Great. You bet.